Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment markets. You know, we're seeing a little bit more volatility as of late, the last few months. I've talked about this before, and one of the things that I want to stress to every investor, short-term volatility is normal, not only in the stock market, but the bond market, gold, real estate, all asset categories have fluctuation. It doesn't mean that we're going into the next recession. So I want to cover that first. First off, all of our indicators, when we look at recessionary indicators, the economy actually slowing, are not prevalent. We're seeing growth in the U.S. economy and we're seeing growth in the emerging markets. The only economies, generally speaking, that aren't doing that great, and they haven't done great for decades, is a lot of the countries in Europe. We're not invested there. But short-term volatility is natural. In fact, statistically speaking, we see at least 1%, 10% pullback in the equity markets almost every single year. It doesn't mean that this pullback isn't going to regain its lost ground and go to new high ground before year end. That often happens. But natural pullbacks of 2 to 5% multiple times throughout the year and 10% pullbacks are pretty normal statistically. Nothing to be concerned about. While nobody ever wants to see their money go down, it's a natural process if you want an opportunity to make a return on your money. By the way, the stock market is not the only asset category that has fluctuation. In fact, last year, most people don't remember this, but we were extremely light and on a shorter term duration in bonds. But if you were like a lot of investors last year and you owned a lot of bond mutual funds that were intermediate to long-term maturity or government treasuries, a lot of those portfolios lost 8, 12, 14, 16% in value. Bonds, they actually dropped last year 8 to 18% depending what you owned. Government long-term treasuries last year lost around 18%. This year, they're up about 16%. So basically in 2 years, if you own bonds, you haven't made any money whatsoever. So volatility is not just the stock market, but it's the bond market. What we're looking at is the economy in the U.S. growing? Is it improving? And so far, with third quarter earnings numbers just starting to get released, we're seeing pretty good numbers on a lot of companies that have recently come out in the last week or so. And also the outlook going forward looks pretty good. So again, while short-term volatility is never fun, it is normal and natural if you want to make a return on your money. What I will say is this. I've had a lot of calls on my TV and radio show. Investors who are bailing, they're selling low and they're buying high. They're going into bonds again at some of the lowest rates we've ever seen. You're not going to make much money in bonds, especially if you try to chase higher yields on junk bonds or on long-term maturities. We avoid these. Those are the risky areas. I firmly believe this short-term correction will subside, and we are watching things closely. We will make changes to our portfolio if and when necessary. If you're a client of our firm, give us a call with any of your questions. If you're not a client, call us for a consultation. There is a difference. We invite you to experience it.